Well, hello everyone. Welcome to Trading the Trend. What a great name for a class, Trading the Trend, because as somebody has already written into the chat, the trend is your friend. So we're going to talk about trading the trend today. We're going to talk about identifying trends. We're going to talk about types of trends. We're going to talk about when you look at a chart and it's hard to identify a trend and it just kind of looks like a dog's breakfast. What do you do then? And we're going to play some example trades. So if you are following Mr. James Boyd in the Land of X, you saw that he threw disclosures to the wind and most of his clothing and put on a bathing suit and has been out tubing. I don't know where, but he looks like he's having a lot of well-deserved fun. So I have the privilege of filling in for him today. We've got Brent Moores in the chat. He is a great guy and an awesome coach. And so if you've got any questions as we stumble through all of this together today, don't hesitate to ask, and between Brent and I will have some answers for you. If you're not following us in the Land of X, like, what are you waiting for? Consider this your formal invitation. My handle, Barb Armstrong CS, Brent Moores CS, and James Boyd CS. So that's that. And before we get into the thick of things, just remember, because we might look at options today, that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges at Schwab, and not all will qualify. We're going to use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to become familiar with the platform, first of all, but two, to make sure you know what you're doing and have an understanding of the trading strategies you want to employ before you consider doing that in a live account. With respect to options, short options can be assigned in a live account. They'll never be assigned early in Paper Money, just FYI. So I've got, one quick announcement, and then we're going to look at, a bunch of charts. We're going to look at trends, and we're going to look at trends in multiple time frames, and we're going to do that by looking at charts. Okay. I guess I should start by saying, and I was in the chat this morning for Kevin's class, and he said, that I came to this as a client. And so I did come to this as a client, as a student of this education. And I was so excited the first day I saw a chart. I think my car about drove itself home. And it wasn't a self-driving vehicle at that time. But I just, I was so excited that I could take control of my own financial destiny if I was willing to invest the time to learn. And, I am female, and women tend to be more rule followers, and I also like to systemize things, because I think that when you have a system, you are less likely to make mistakes. And so, I started with stock investing, and then I went to options because, and you can do things however you want. That was just my journey. But when we looked at trends, we've really got three trends, right? Like, something can be uptrending, and, it doesn't tend to just go straight up, or it could be, going sideways. And so that's a consolidating pattern or a sideways pattern. And with up tends to maybe go like this, or it can be downtrending. So, generally speaking, we've got three types of trends. And, for stock investing, sometimes people tend to look, this is kind of where they want to be, right? And it's okay to be here, but this is really what people are looking for quite often as a stock investor, where they're looking at a buy and hold strategy. Now, if something pays a nice dividend and it's consolidating, but maybe it's been uptrending and then it comes in and consolidates, and the expectation is that when it's finished consolidating, it might break to the upside. But you have to be prepared that it could break to the downside. And one of the things that we want to be aware of when we're looking at something that's consolidating, if we own the stock, what might we do? Well, we might say, well, I'm going to sell a covered call. When it comes and bounces down, if it does the same thing again, I'll sell a covered call. And when it gets back to this support level, I'll buy it back. And then if it comes back up here and does it again, I'll do another one and I'll buy it back. when it comes back and bounces here. But, you know, and if I do a third one and buy it back here, this is when it's important to have rules, because maybe it comes up here. If it starts to pull back, we might buy another one and then end up called out. So, you know, or we might have to buy it back at this one at a loss. You know, or we might just have to employ some discipline to say, hey, I'm going to wait, not when it comes up and kisses it. I'm going to wait until I have a candlestick pattern that tells me that it's rolling over. Okay. And you know, if something's going sideways, what else could we do? So we could do a covered call. You know, we could do, when it comes down here, we could sell a put. So we could sell a put, that's bullish. But if we sell a put, that kind of requires a few bucks, right? Because depending on the type of account, if it's a cash secured put and this stock, you're doing this at $100, you've got to put $10,000 aside, you know, until you buy that put back and take the risk off the table. So what else could we do? We could do a short put vertical when it comes down here and bounces. You know, if it's going sideways, we could also do a short call vertical up here. But this is kind of a bearish to neutral strategy. And if you own the stock, you're probably, you know, feeling more bullish than bearish. But if you don't own the stock, you might say, I'm just going to, you know, try and take advantage of this trend and profit from this trend. But you might be more likely to do a short call vertical when? Well, how about if this stock had been downtrending and then came here and started consolidating? Because your expectation is that the probability might be higher that if it breaks to the downside, and then your short call vertical. With a short call vertical, we want to be sure, our expectation is that the stock is going to stay below the strikes that we have sold. So, you know, even if something's going sideways, we've got choices. And here we might want to be long stock if we're buying. Long equals buy. So we could just buy the stock. And then we could do any number of other bullish trades. Again, if something's uptrending, we could sell a put, which is bullish because we're agreeing to buy the stock. Okay, we could do a short put vertical here. When it bounces, we could do a long call vertical. You know, with the expectation, with the goal that it's going to go through both our strikes and then keep on trucking. You know, so we have lots of choices. And what about if something's downtrending? Well, if we see it start to roll over, we could do that short call vertical, that bearish to neutral strategy. We could buy a put in trader speak, long put. Long put. Okay. And here, of course, we also have, you know, if you're starting out and you have a smaller account, you might say, well, I'd like to buy a call. And you could do that because buying a call controls typically 100 shares of stock. You know, you don't have to buy the 100 shares of stock, but there's, you know, they're time sensitive. So if you buy a call that expires in 50 days, if the stock hasn't moved in 50 days, you know, if it ends up going sideways, that, you know, that option could expire worthless. You could lose 100%, where if you had the 100 shares of stock and the price was still around the same price, you might not have lost anything. Okay. Now, one other thing about trend, so let's just like shake my little Etch-a-Sketch there, is that we have trend in both a stock, right? So we want to, when we're looking at trend, we want to look at what's happening with the stock. And then when I first started, and, you know, I was saying, you know, I started with stock investing. One of the things, and I had a checklist, and it was like the first thing on the checklist was, is the stock uptrending? Yes or no? And I would literally put a check mark. Brent, do you remember those checklists from back in the day? Is the stock uptrending? And then is the sector that the stock is in, is that uptrending? Yes or no? And then what about the market in general? Is the market uptrending? Because if we were to have, had this conversation back in March, the market, it was not uptrending. It was like on the struggle bus big time. I don't know why my drawing tool is the market uptrending? Because if we're looking at, the flow, we want to go with the flow of the river, right? Like, what's the cool thing? Have you ever gone to the Atlantis Resort in the Bahamas? They have a lazy river. And lots of places have lazy rivers. The Atlantis also has a not so lazy river where it's just flowing that much stronger. And the cool thing about it is you get in the river and you go with the flow. Like, who wants to be going upstream? And I have spent thousands of hours, in canoes and in kayaks. I used to do a lot of white water in the spring when the spring runoff is happening. And so, when you're going with the flow of the river and you're using the river to help you get where you want to go, if you have to paddle upstream, man, that is tough going. And so with respect to the stock market, this is why we call this class trading the trend, because we're looking at, what direction is the market going, first of all. And then we're going to look for stocks that are going in the same direction as the market. And we're looking for sectors that are leading that market, and then stocks within that sector. Okay. So I'm getting off my pedestal now on the trend. So let's go out and let me get through my one announcement. And that's, people have been saying welcome back and sorry we missed you in Chicago and sorry we missed you in New York. Trust me. I was trying not to pout as I was doing my physiotherapy, knowing that I could have been in New York or Chicago. So I will be at the Dallas Market Drive on September 20th, and I will be in Chicago. I am going home for Canadian Thanksgiving, so I'll miss the Orlando event. But if you've never been to one of these in-person events, if you live within driving distance, even if you don't, I used to get on a plane. I lived in Michigan. I'd fly to DC. I ended up with a job because I came to an options class here in the Salt Lake City area. So go figure. Yeah, but they're wonderful events. And I mean, we'll have the coffee on, we'll have coffee ready for you, we'll have breakfast, we'll have lunch brought in. And on these market drives, we'll have a reception afterwards. And so I hope you'll consider coming because I think they're fantastic. But register quickly because, we can only fit so many people in a room. So they do get maxed out. They're free to attend. And I hope you'll take advantage of those. Okay, so given that I've talked about trend and looking at the market first, what's the SPX been doing? Well, you might say, well, everybody has their knickers in a twist and Chicken Little is in the, in the barn warming up because the market's been pulling back for the last 4 days. But do we see a break of support? We don't. Do we? And how much, we were on the struggle bus here, we were pulling back, in February and March, but we got to the beginning of April, and this is over a 30% move, if I do believe. I've been gone, so yeah, it's about a 30% move from the tippy top, about 34%. And this is a 30-day moving average, and then I've got a 10-day moving average, and I've seen questions in the chat like, how come the coaches all use different moving averages? Some use an exponential moving average, some use the 50-day moving average. And the reason that I use these two moving averages is because when I first started with this education back in 2011, the coach I first followed, these were the moving averages that he typically used, and these were the colors. So I just did what that particular coach did. And it served me well, over the years, but there's nothing to say that a 20 or a 50-day moving average can't do exactly for you what you want it to do. So it's really just personal preference. But when we look at this has come down, since it started taking off back in April, and it's, done a little kiss and tell once, twice, 3 times a lady. It's kissing again. Like tomorrow we have, news coming from the Fed. And so the market is a little angsty, I think. That's just my personal opinion, but I'm probably not the only one with that opinion. And I think may see things kind of settling down a little, after we hear from, the guys who are, at that meeting. So, but the uptrend is still intact. That's the net of it. And when we look at the NASDAQ, which is our tech heavy index, it's more of the same, right? Like since this April 7th date, even at this point, it's up almost 40%. At one point, at the tippy top there, it was up 45. And you may say, well, yeah, but Barb, like today it's below. Oh yeah, but it's one day. And do we call that a breakout or a potential fake out? Or breakdown or potential fake down? Like, I'd want to see some confirmation. And it's done this same, kiss and tell on the same dates. And so, we're within the realm. And so overall, what does the trend look like? It's been uptrending. Okay, so let's look at a couple of stocks. So, how about Google? The Goog. We've got Goog and Google. And, yesterday I posted a very short video. It's under 2 minutes on X on the S&P and kind of who are the heavy hitters in the S&P. And spoiler alert, Google is one of them. And what do we see here? It's kind of tracked what the market in general was doing. The S&P and the NASDAQ were pulling back. This is in the communications sector. How do I know that? Well, if you come to the Analyze tab and you come to Fundamentals, it'll tell you what sector here. And it looks like, at least several of the analysts that follow this, are bullish or have a high opinion of Google. You can come and download these and look at these. And these are just opinions. So it doesn't mean that, they're always right. They're not always right. And you can also scroll down here. And once you've looked at the trend, say, well, do the fundamentals support it? And here's our 5-year trend and their, earnings per share, book value, sales per share, all of these are going up. Now, does that guarantee for the next 5 years they'll go up? No. But we've gone from $13 a share, $13.28 a share in 2020 to 28. So that's over 100% gain. And the earnings per share has gone from just under 3 to just over 8 in that 5-year period. So, something they're doing is not too shabby. Some would say it seems to be working for them so far, but when we look at this chart, we've seen this pretty dramatic uptrend, similar to the NASDAQ. And today we have this candle. Now, when I looked at it an hour or so ago, because we can see by this candle that it opened here, it ran up. So this was a more bullish candle when I last looked at it. But if we think that this trend is likely to continue, what else might we want to check? Well, we might want to come to the communications sector. And this is just a watch list. It's a public watch list. I've come to S&P 500 sector indices. That's what this is. And then we've looked at the last 4 weeks and the last 3 months. Communications leading the pack. And similar to the S&P, it's been pulling back, but the overall trend has been uptrending. So we've got market uptrending, sector uptrending, stock uptrending when we come back to Google. Now, we could say, well, I want to see more confirmation. Now, when we come in, and I've done a series of short videos, and I don't know if I got to bullish Harami, but if you look at this and say, well, this appears to be at a support level, and the body of today's candle is totally inside the body of the previous day's candle, that combination of these two candles does not require confirmation. Now you might say, well, I look at it and I see an inverted hammer. And you know what? Both are right. But with the inverted hammer, what you want to see is it close the next day above. Now, tomorrow we'll get together in trading a smaller account. But if we said, well, you know, I would like to add Google to my portfolio, and I think this might be a good time, and I'm okay if it pulls back a little. Now, if you wanted to do a short-term income generating trade, you might say, I would prefer to wait because I want to do a trade that only lasts 2 to 3 weeks as opposed to, you know, adding something to my portfolio that I might continue to have, you know, as long as this trend continues. See what I'm saying? Okay. So based on that, if we said, okay, we're going to add this to our portfolio, we aren't going to put a target on it, but we want to put an exit in to define our risk. Otherwise, this account has $500,000 in it. So if we said, okay, we could have a $25,000 position, that's 5% of the portfolio. So we could buy 100 shares, but we don't want to risk more than $2,500 on any one trade. So what might we do? We might say, well, where do you see potential support being? And so this is where, you know, the art of trend analysis comes in. And, you know, we may not all see things the same way, but I see this as a previous high. And now it's come back and it's retested it once, twice. So if we said, I see support around this 196.84 level, so we're going to put a stop here at 196.84, and we're going to knock off 3%. So times 0.9. So we're going to go 3% below that to give it a little bit of wiggle room. So our stop would be around 190. And that would be below this 30-day moving average, which it's come below it a couple of times, but it's just kind of nipped below, and then this uptrend has continued. Okay, now another choice we might have is to say, well, I would rather buy a protective put, and that way I don't risk getting nicked out. I call it getting nicked out on a wick, and then the thing turns around and goes up, and that kind of frosts your petunias. But for today's example, we're just going to use this as our stop. If it were to gap down, there's no guarantee that, you know, we get out at exactly this price we're requesting, but Google is a pretty heavily traded stock. You know, Google, as I referred to the one with an L, almost 10 million shares traded today. So we are going to buy custom with an OCO bracket. And, oh, sorry. I've been doing a lot of OCO bracketing this week. So we're going to just buy custom with a stop. We're going to put our stop at 190.93. Have I got the 1 in there? Yep. Make that good till canceled. So we want to buy 100 shares of Google, 199.67. We want to sell if it goes down by $8.74 a share. So that's, you know, we're risking about $875. Now, if it gapped down, we could lose more than that. But, you know, our position sizing rules, and that was on that first sheet that I had made. Like there was a little thing at the bottom. It was, okay, is it trending? And there were a number of other fundamental markers to look at. And then it was, how do you calculate your position size? And, you know, you have to make a decision based on the size of your account. What percentage do you not want a stock to go above. So we said 5%. That would allow us to have 20 positions in our account, stock positions. And we don't want to risk more than half of 1%. Now, in a smaller account, like our trading a smaller account, our number was 2%. So we had a $25,000 account. We were willing to risk up to $500. And so we couldn't buy 100 shares of Google in that account. Plus, it's, a $20,000 position. That would be, the majority, it would require the majority of our funds. And so too many eggs in one basket. So we're going to do this as a growth stock. So we're going to put that in our growth stock group. Okay. Okay. Now let's look at RTX. And because the S&P is pulling back today, there are a lot of stocks that are pulling back as well. But RTX is not one of them. Now, when we look at RTX, the market is still the market, right? So that's been uptrending. It's interesting. On April 7th, it hit a bottom like so many other things in the market, and it started to rally, but then it really got hammered on earnings. Even though it beat on earnings, it came back down and then started its journey upwards again, and has kind of kept on going. And in the last, we started here at the end of July, it started going up, but at the end of July, it started pulling back. So we had this kind of panic pattern coming together. And today, what's happened? Well, yesterday, it had a big move to the upside, and today it's kind of following through, isn't it? You might say, well, RTX, I'm not even familiar with this company. Well, we can come to the Analyze tab. It's in the industrial sector. So one of our questions is, has the industrial sector been strong? So let's come and look at that. Well, that's been uptrending. Last month, it's setting up its own panic pattern, as we all know. I've been away, so I've been doing a lot of, clearing my line drawings, and this one too, setting up kind of this pennant or triangle type pattern, right? Now, it's setting up this pattern. It hasn't broken out yet, but when you look at this pattern, would you say that it's been intermediate term uptrending and then shorter term consolidating? Yeah, PS said it's a diagonal breakout. Yeah. So when we come back to RTX, and we look at that, and there's a number of things we could do. One of them, and one of the things on the checklist was, does it trade more than you might, if you want to trade options, like have the ability to sell a covered call, you might want this number to be 1 million shares a day. If you're just going to buy and hold a stock, you might want it to be 250,000 shares a day. But if you're saying, hey, I want to be able to do this and maybe sell a protective put when it comes close to earnings, or maybe sell a covered call, I want it to both trade 1 million shares plus, and I'm going to come out and look at the options and just make sure that there's some options activity. Now, what if you're saying, okay, the last one you did was a trend trade, and that's all like tickety-boo, and that's lovely. But here's the deal, sweetheart. Like, what I really want to do is earn some money, because I want to go to Paris for Christmas, or I want to take the kids to Disneyland, or, I want to pay off my car. So I'm looking to generate some income. And so I don't want a long-term love affair. I am not shopping for rings here. I just want a dating strategy that might make me some money. So, but I do have some cash in my account. Well, so it's at 157.30. Could we come out here and maybe, like, if we're expecting this trend to continue, could we buy a covered call at maybe 160 with the intention of getting called out? Well, that's a thought. And what would that do for us? Well, if we came to the trade tab and we come out to September, so 29 days away, we look at the 160. Well, they'd pay us 221 to 237. Are we the only ones who've looked at calls? Like there's 4,618 calls on this thing. Like that's a huge number. 216 traded today. That's the difference between open interest and volume. Okay, volume is number of contracts today, 216. And this is saying you have a 75% chance it's going to at least come up and kiss 160, a 38% chance it'll be in the money at expiration. So if we said, okay, that sounds interesting. We want to buy covered stock. So we're looking at buying 100 shares of RTX and selling this 160 call. And if we get called out, we're totally cool with that. And how much could we make? Well, the most we can make is the difference between what we're paying to get into the trade and the 160. So that would be $4.87, almost $5. Well, $4.90. And if I divide that by the 155.10, that's about a 3.1% potential return. Or if you're saying like, yeah, just show me the money, well, you're making about $500. You know, if 489. Now you might say, hey, if I get to the point where I've made 450 of that 489, I'm good to go. You know, I'd be happy with that. And maybe your goal is, you know, to make $1,000 a month towards your pay off the car fund or trip fund or whatever. And you could have some trades that end up taking money out of that fund. And, you know, how much could we lose? Well, here it's saying, well, if RTX went to zero by September 19th, you could be down 15 grand. Well, we don't want to risk that, right? And so what we're going to do is come out to the charts and looking at the trends say, well, we see support around this 30-day moving average, around this 154.36. Our recent low yesterday was 153.09. So I'm going to take that 153.09. That was our low yesterday. And we're going to go 3% below that. And it could go 2%. You could go 5%. I'm just using that as an example. So that's 148. If I did that right. 154.36 times 0.97. Oh, it should be 149.72. So sorry, 154.36 times 0.97. 149.72. So, you know, that's down here. You might say, well, I don't want to lose that much. So we're risking about $800. That's within our realm of acceptability. But what that does is, if our stop is down here at 149, the probability of us being stopped out goes down. If we tighten up our stop to say 152, we've got a 58% chance, 57% chance of being stopped out. When we're down here around this 149 level, you know, it's more like 35%. Okay. Now, if you say, well, I'd like to put an alert in instead of a stop, you can do that. I just want to show you how to use a stop, how one could do this. Because I met someone in Chicago who really liked this strategy. His goal was to make $100,000 a year. I didn't know his account size, but he just said, I said, what trading strategy do you like? And he said, I like buy right covered calls, but I can't protect myself to the downside. So because of that conversation, you know, I want to show you how you can protect yourself to the downside. So you're going to make this your advanced order first trigger sequence, right click, create an opposite order, and we're going to make this a market order. That's good till canceled. And we're going to exit this based on the price of the stock. So, because we don't know quite what the option will be worth, but we're going to say, hey, if RTX goes at or below 149.72, then we'd like to exit this position. So we are defining our risk. Even though when we go to this confirmation tab, it won't recognize this stop. And again, if it gaps down, we could end up paying less to buy the call back, but receiving less for our 100 shares of stock. So we want to buy 100 and then 100 shares of stock, sell that 160 call. The goal is to be called out. And we're going to put that in our buy right covered call bucket. Okay. And our cost, 15,000. We're not doing 200 shares because that would be over our $25,000 limit. Okay. So we've honored both our position sizing rule with regard to size of the position, and also our position sizing rule with respect to how much we're willing to risk on any one trade, which we wanted it to be under $2,500. Okay. Okay, so let's look at NVIDIA. Why not? Because people look at NVIDIA every day. Now, this is a stock that's had quite a journey, right? But when we look at this, it's had this beautiful move to the upside, pretty dramatic, similar to what we've seen happening with the S&P and the NASDAQ. Only this one is up almost 100%, even with this pullback. And the last 2 days, we've had kind of these hammer patterns setting up, right? But what do we have coming up? We have earnings on the 27th. So where's my calendar? The 27th. So that's Wednesday of next week. And, when I first started with this education, you could call and talk to a coach. And so I'm reviewing like my checklist and, and I've diligently gone over everything. And he said, well, did you notice earnings is tomorrow? And I said, no, that wasn't on my checklist. So I added it to my checklist. Yeah, so I added that to my checklist. So some people might say, I don't really care if earnings is next week because, the last couple of earnings announcements, this stock has done well. And so if you were to buy shares now, and again, we had this hammer pattern, and this hammer pattern does require confirmation. It says, I want to see tomorrow a close above to this day's close. And so far, we don't have that. And now we have an inverted hammer or doji, and the confirmation says you need to wait for it to be above. So from a following the candle rules perspective, we don't have an entry here. So even though we have trend and we have something that's in a tech sector, and the tech sector has been strong, all the sectors have been strong, in one way or another. So if somebody in the chat is asking, what do I mean by being called out? So if we go back to, it was RTX. So we sold a covered call here at 160. So I'm just going to edit this. So if this is a new strategy for you, I have an example trading plan under the trade management mini session section. And I'll show you where you can listen into that. But if we look at this, we've bought shares and we've done what we call a buy right covered call. So we've got this buy right covered call on here. And the expectation is that the stock will continue to go to the upside and that will end up being assigned, because if it's trading above, let me just get my drawing tool here. If it does go up and it's trading above 160 at expiration, your shares will be sold. Now, if it's at 165, what price will your shares be sold at? 160. And so you may say, well, that sucks. Like, I shouldn't have sold the covered call. But if you're saying I'm doing this as an income generating strategy and I'm happy with a 3% return in, under 30 days, then there's no crying in your beer. You're saying like, I'm totally cool with this. And I'm going to make my $500 or my 450 or whatever that number was. And I'm going to go with the flow. Now, because NVIDIA has earnings coming up, the premiums will be higher. But if it gaps down, you could lose more. So if you just said, well, I'd like to could we do that earnings generating strategy on NVIDIA and maybe sell this 180? Like, we've got 45,000 contracts here, and 675. And if it goes up $6, and then I could make another 6, or maybe do the 185. You've got 100,000 contracts here. So if it goes up to 185, you could make $15 a share. So we aren't going to take the time to put this one in, but you could make basically $15 a share potentially, but that is your max gain. You could make $1,500 on a $170 investment potentially. So it's not a 10% return, but it's getting close to it. If the stock were to go up. Now, it might not. You could also get stopped out. Yeah. Somebody's saying, oh, and their name is Chicken Little. A lot of my beers have a salty, watered down taste. Thank you for that humor. I really appreciate it. So guys, our 45 minutes, it has come and gone really quickly. I appreciate you sticking around, even though James was MIA today, but he's taking a well-deserved vacation, and I hope he's having a blast. He'll be back before you know it. He'll certainly be back for this class next week. So what did we do? One of the things when there is a survey, and I don't think there is for this class, we looked at 3 stocks today. NVIDIA was one of them, and we placed trades, example trades on Google, and we, that was a stock trade, and then a trade, an potential income generating trade on RTX. So I hope that you found this informative. If you haven't hit the subscribe button, please hit like. It helps move this up in the algorithm so that more people can find this content. And then hit the subscribe button if you haven't already subscribed to the Trader Talks channel from Schwab Coaching on YouTube. You'll want to do that. And then don't forget to follow Brent and I in the Land of X, Barb Armstrong CS and Brent Moore CS. And I think that's it. That's a wrap. Many thanks to Brent for hanging with me in the chat, and to all the people behind the scenes who helped bring this class to life. Take care, everyone. I'll see you tomorrow for Trading a Smaller Account. Stay tuned. I believe it's Connie Hill that's up next with Trading Short Verticals. Take care, everyone. Bye for now.